market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai. Well, the information reporting that Meta is in talks to spend billions of dollars on Google's AI chips. An agreement would help establish Google's chips as a rival to the industry's best-selling AI accelerator made by Nvidia. So take a look at the respective price action. This is the first glimpse that we're getting of pre-market price action. Nvidia down 2.5%, Alphabet up almost an equal amount, 2.7% firmer. And what we're seeing is more competition come through, especially with those TPUs, an important AI accelerator component, in addition to, of course, the launch and the success of Gemini, a competitor for OpenAI. So this is one of the big themes that we're watching out in the tech space this morning. One of the other big themes is vis-a-vis growing calls for a rate cut. So let's talk about that. Confidence is growing for a potential Fed rate cut in December. Governor Christopher Waller says he will advocate for an interest rate cut at the next meeting.
My concern is mainly the labor market in terms of our dual mandate. So I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released. And if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Well, traders are now pricing in an almost 80% chance of a U.S. rate reduction next month. Let's bring in Bloomberg Markets Live executive editor Mark Codmore. Mark, it wasn't that long ago that there were only 6-7 basis points priced into the meeting next month, and now we're looking at 19 basis points. All of that has happened in the last couple of days. What is it about the Fed's messaging? What has prompted the Fed's messaging to change?
I think Williams' speech at the end of last week was absolutely vital here. He's seen as a bit of a spokesperson for Powell, and importantly, he was the person who hadn't said much recently. So his kind of guidance that there would be, there's possibility of a rate cut in December, kind of spoke to the way that Powell is probably leaning. And I think Powell's probably got the votes to deliver that rate cut. We're in a slightly strange dynamic that the Fed blackout period starts this Friday. Normally, we have a decision about 80% priced or higher going into that blackout period. Fed officials make sure that the pricing is right. They don't like surprising the market. And it's very rare that we then change plans. It's obviously completely different this year because we've got so much delayed data coming through from the shutdown that there's a genuine debate out there. But I think that the messaging from Williams last week is very important. I think that the base case now is that we will get a rate cut in December, and it'll require the data between now and then to kind of really surprise, to change that narrative. There is a lot of data to come which has the possibility to do so, but I don't think we're going to get enough of the kind of the headline CPI and jobs data that's going to really change things.
Yeah, and looking ahead today, we have obviously retail sales and PPI on the docket as well, something to watch out for there. But I guess if you look back at that jobs report, the delayed jobs report that came through, maybe the market simply misinterpreted it. The strength in the headline should have been focused more on that uptick in the unemployment rate. Do you think perhaps that is really what the Fed policymakers are focused on here, the weakness in the job market?
I think that's definitely a viable narrative, but you've got to remember that's also an outdated jobs report at this stage, and we're going to then missing some jobs data. I think the fact is that because of the administration pressure, because you've got several candidates on the current board who are angling to be a potential to be the next Fed chair, you've got pressure to provide easier policy than orthodox monetary policy, economics would suggest. So in orthodox economics, there's no way we'd have enough data to justify a rate cut just yet in the US. But people can't risk being behind the curve. They want to err on being premature if they make any error, which is not how normal orthodox central banking should work. Normally, it should work that you wait till you're definitely going to a recession and then you cut super aggressively. Premature rate cuts aren't always a good idea, especially when we've had an inflation scare in the last few years. But we are erring towards being a premature rate cut. And I think that because of that, there are enough inconsistencies in the data to say that, hey, maybe the economy is slowing enough to provide what Donald Trump and the administration wants. And that's why we're leaning that way in the pricing.
Yeah, Always good to chat to you. Bloomberg's Markets Live Executive Editor Mark Cudmore laying it out for us. Well, another day, another debate on private credit, this time with Apollo's Mark Rowan weighing in, saying that people have, quote, lost their minds over private credit fears. If he's right, where should we be looking for credit opportunities across both public and private markets? Joining me now to discuss is Omotunde Lawal, head of EMEA Corporate Credit and EM Corporate Credit at Barings. Good to have you with us. Before we lean into the opportunities, I just want to bring it back to something that our colleague Mark was just talking about, which is what he's referred to as a premature cut. Other people are calling it as an insurance cut. Do you think we're going to get that out of the Fed this December?
Thanks, Jemana. Yes, certainly. I think if you look at the last sort of 4 weeks, we've seen quite a lot of sort of big swings in the market with what the market is pricing in about the December rate cut. We've gone from less than a 90% chance to less than a 30. Sorry, more than a 90% chance, less than a 30, to now around 8% chance. So certainly the market oscillates between the narrative of a weak labor market to a weak labor market plus sort of AI tech bubble to what it seems to be AI bringing productivity gains and all of that. And certainly from where we sit today, it does seem like we're set to see perhaps this rate cut for December. And generally what we're thinking there is potentially there is a scenario where you're seeing this dichotomy play out for much longer, where the front end of the yield curves are anchored down by this sort of concerns around the weaker labor market, but actually the long end starts to price in the expectation for next year, where ahead of midterm elections, the U.S. probably starts to come back to life with some of the tax cuts that are due to come from the one big beautiful bill, the sort of high tensions from trade uncertainty starting to fade away, and some inflation starting to creep back in there. And so potentially you do see a scenario where the Fed, as Mark was saying, preemptively cuts in December, but then we have a scenario where the front end of the curve is anchored there lower, but actually the longer end of the yield curve actually starts to price in this stronger growth picture for U.S. for next year. You've seen quite a few of the sell side guys have actually revised out their U.S. GDP growth forecast for next year.
Yeah, it's interesting you mentioned the shape of the curve as well, because you have seen just in the last couple of days money pour into the front end of the U.S. yield curve. Is that also happening in EM, or has it yet to catch up?
So within EM, for us, generically, I mean, lower rates is good for everyone because everyone's pricing off of that, right? So EM generically has benefited from the fact that U.S. rates coming down or the Fed cutting rates is good for yield-seeking assets. If I think about what history tells us that EM corporates actually have generated quite positive returns after peak Fed rate. We've seen peak Fed rate since July of 2024, and so we're seeing EM returns sort of matching what history tells us. I think year-to-date coming up to July of this year, we've seen EM corporate returns coming up around 18% cumulative, which is in line with history where cumulative EM returns post-peak Fed rates has been anywhere from 18 to 22%. So EM generally benefits from that. And for us specifically, we actually find the short-dated part of EM corporates quite interesting because that again speaks to the kind of rates volatility that we've seen. If you focus on the short dated part of the curve, you're minimizing that volatility that you ordinarily get from the swings with is the Fed going to cut, is the Fed not going to cut, what are rates doing or rates not doing. And that's why we like EM from the perspective that EM is less vulnerable to all the AI tech bubble noise, but also the short dated part of the curve because you benefit from what we think might happen with the front end being more anchored and with the long end reflecting a stronger growth picture for the U.S. next year.
And to be clear, you're buying this on all-in yield as opposed to on a spread basis. Spreads, you could argue, credit spreads are extremely tight. It would be tough to see a replication of 2025's performance in 2026. So what is the best way to position?
Correct. We're really looking at all-in yields here. When you look at yields, especially on the sort of EM corporate side, you're looking at IG yields anywhere from 4.5% to call it 5.25%. And that's actually quite interesting for us. And when we look at that, you're still seeing a 20 bips pickup to developed markets for the investment grade portion. And you're seeing anywhere from 80 to 100 bips pickup against developed market on the high yield segment of the market. So actually, that's still quite interesting when you look at it on an all-in yield basis.
Yeah. I want to ask you about private credit and pick your brains there. And I wonder whether there's some crowding out effect that may be going on because of the sheer amount of investor interest there is in getting exposure to the private markets. Is that moving attention away from some of the public markets that you look at in EM and, of course, in DM as well, but EM in your case?
So we've seen a huge amount of interest in private credit, and the size of the market, if you believe any of the stats out there, is anywhere from $2 to $3 trillion, and that's certainly taken some of the heat off our public market. Some of the issuers that might ordinarily try to come to issue in our dollar public market have probably found other avenues. So it's become another lever that borrowers can pull in terms of private credit. Is it taking away business from the public side of the market? No, not necessarily, because I think it's just another lever for the markets to pull, and I think it also provides a bit more diversification for capital structures for different borrowers. So it's a good thing in terms of that. In terms of whether or not there are concerns of what is going on in the current private sector space in terms of a couple of instances of distress within the private credit market and what it might mean for the public's market. We definitely keep an eye on it, because if you see distress in some private credit sectors, it has the potential to reprice leverage loans, which then has a potential to reprice all of credit, EM included. Potentially, that also has the impact that where some investors suffer some distress or credit events on some private credit stuff, they might be seeking liquidity or redemptions from other liquid parts of their investments, and that tends to come through from the public credit side, which impacts us as well. And also just general risk sentiment, where sometimes if these sort of credit events persist, that general risk sentiment around credit in general also has the potential to impact us. So we do keep an eye on it for multiple reasons. The repricing risk, the liquidity risk, the credit sentiment risk. These are all the reasons why we do keep an eye on what's going on in the private credit market. But by and large, we find it quite encouraging that there is just another lever for investors for borrowers to use in terms of borrowing, especially in EM. We are starting to see a lot more private credit activity within emerging markets. Markets like India, we're seeing a lot more private credit activity.
Yeah, makes sense. We've talked about the fundamentals being solid, the fact that many of these EM economies have undertaken reforms that are actually beginning to pay off. I just wonder, from a technical perspective, what you think issuance is going to look like for next year in an environment where the Feds continue with their easing cycle. Will you see a lot more issuance come to the market from some of these EM issuers?
Yeah, I think if you take a step back, you look at this year, EM corporates, for example, gross forecast for supply for the year from JP Morgan, who we track closely for the asset class, originally was supposed to be something about 430 billion. That got revised upwards. I think right now the forecast for the full year for 2025 is something about 460 billion, and we're currently around 455-ish billion. So we're very close. It probably will exceed the upward revised forecast. And that is in comparison to the US IG market, for example, where they've had a huge amount of supply. I think the number that I heard more recently is a net supply of about 800 billion, which is up 60% year on year in the US. And a lot of that is the AI and tech capex investments driven supply. Do I see that repeating in 2026? Absolutely. I think some of the numbers that are being thrown around in terms of AI tech investments for the next few years varies from 5 trillion between now and 2030 to 9 to 13 trillion per year between now and 2030, depending on whose sell-side research you believe. So that's a huge amount of supply. And that will be funded through developed markets. Some of it will emerging markets, some of it will be public, a lot of it will be private, and some of it will be equity. So do I think some of that sort of seeps into the emerging market space? Absolutely. You've got the likes of the Babas, the Tencents, the China tech companies. This morning you were speaking about Google buying chips from Meta. Some of that sort of AI capex with China is also in that race. Some of that AI capex will be funded through EM as well, but I think it pales in comparison potentially to the supply that we will likely see from developed markets.
Yeah, so interesting to make the comparison between the two. And actually, it's DM where the issuance is getting ramped up. Omotunde Lawal, thank you so much for joining us. Head of EMEA Corporate Credits and Emerging Markets Corporate Debt at Barings. Thank you so much. Coming up, Russia and Ukraine exchange fire just hours after President Trump struck a positive tone on the prospects of a ceasefire. More details next. This is Bloomberg.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
U.S. Commerce Secretary Howard Lutnick saying Brussels needs to change its digital regulations in order to get a deal to lower steel and aluminium tariffs. Now, the EU's antitrust chief has since ruled out easing the bloc's tech rulebook. So for more, Bloomberg's Hong Kong news desk editor Balazs Pence joins me now. So the EU really digging their heels in here. It seems very unlikely that they're going to yield to the U.S. demands to make modifications on the digital rulebook.
That's correct, Jumana. The U.S., especially the big tech companies, have long been pushing to ease some of those EU digital regulations. Some of the biggest companies like Meta, like Amazon, like Apple, I could go and list almost the entire Max 7. They have been hit by multi-million-dollar fines, lengthy litigation processes. So they have been trying to push the EU to ease on some of those rules. And clearly, the White House now saw an opportunity to tie those regulations to the tariff talks. As Howard Lutnick mentioned, we just heard him talk about the metals tariffs. They thought that there may be some leeway if they tie these two issues together. But the EU was very firm, and they said immediately that these regulations are not up for negotiations. They don't think they are discriminatory. They say that these apply for all companies, including European companies. And they say that these are vital to protect the interests of European consumers. So as Howard Lutnick said, the EU is a large market, 450 million people, and if American companies want access to the market, the Europeans are saying they have to play by the rules.
Yeah. Well, let's switch over to something that's closer to your neck of the woods. President Trump has spoken to both President Xi and Prime Minister Takaichi. Obviously, we know that there's a bit of a diplomatic spat going on between China and Japan right now. How delicate is the U.S.-Taiwan tightrope?
Well, I think you have to look no further than the fact that President Trump spoke with both President Xi and Prime Minister Takaichi over this issue. And from Beijing and Tokyo, we heard that it was the U.S. side that initiated those talks. So clearly, Trump is trying to insert himself into this very, very delicate situation and trying to keep both China and Japan on his side. Let me just remind you, the U.S. is in the middle of very important trade negotiations with China. So the last thing they need is for those to fall apart over the issue of Taiwan. Trump had a very important meeting with President Xi in Busan not too long ago, and both sides described that as a very good meeting. But crucially, the issue of Taiwan did not come up. So now the issue is back on the table, and the president needs to make sure that Japan, a very important ally, stays on its side, but at the same time, he can continue building a constructive relationship with China.
Yeah. Bloomberg's Hong Kong news desk editor Balazs Pence, thank you so much for the overview. Well, Russia and Ukraine exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Bloomberg's chief Europe correspondent, Oliver Crook, joins us now. So, Oliver, this Thursday was supposed to be the original deadline for Ukraine to agree to the peace plan presented by the U.S. What is the latest on these negotiations? Where does the peace plan actually stand?
Yeah, I would begin by saying that the Thursday deadline is probably a pretty fluid one. This is something that Marco Rubio, the U.S. Secretary of State, suggested after those Geneva talks that lasted about 24 hours over the weekend, that basically this may not be the fixed and the firm deadline, because as you know, Jumana, this is an intensely complicated issue to deal with a great many issues, from sort of NATO-like guarantees for Ukraine, territory swaps, all of these sorts of things still need to be thrashed out. But of course, the U.S. administration's ambition is to put a fire beneath the Ukrainians, beneath the Russians, and try to drive everybody to the negotiating table. So what we started with was a 28-point plan. We understand that we now have a 19-point plan after those discussions in Geneva that is now being shopped around to the various parties. We should say that today the attention is in the UAE, where Dan Driscoll, the Army Secretary of the United States, who's now taking a larger role in these negotiations, has been speaking with Russian officials. We should say that the Russian officials were quite dismissive initially of this now 19-point plan, but we should say, again, this is an ongoing negotiation. It seems like this 19-point plan is currently the sort of living document that we have that is being amended and being shot back and forth between the two sides. And we should also say that we're hearing just now from some Ukrainian officials over the last couple of minutes here saying that there's an expectation that President Zelensky will go to the United States within the next 4 days before the end of the month of November to discuss with Donald Trump, because another thing, Jumana, is within that 19-point plan that the Ukrainians gave back to the United States, many of the most difficult issues, such as territory and some of the other political solutions, have been left off the list because Zelensky wants to speak to Trump about it personally.
Yeah, what are the types of measures that the U.S. and Europe can exert to get this across the line?
So I think for both sides, we've talked about it many, many times, Jumana, and I'm sorry to sound like a broken record, but the main point of leverage for the Europeans is about those Russian assets that are now frozen, 140 billion euros worth of them that are sitting here in Belgium. They have not had consensus on how to proceed with that. There is some question now because those assets were discussed in the 28-point plan by the United States. Are they now off the table, or is there even more urgency for the Europeans to move on it? That is kind of a divided opinion within Europe. But we should also say, Jumana, we shouldn't forget two things. One, that sanction package on Rosneft and that went into effect, that happened last Friday. That is going to begin to start hitting the Russian economy over the next weeks and months to come. And there is, of course, that bipartisan bill about secondary sanctions that would really hurt Russia that is sitting with the Senate. That just takes Donald Trump to put it forward. It's one of the few things bipartisanly there is agreement within the United States that would go through, and that would damage Russia immensely if Trump wants to pull that trigger.
Yeah. The story that we're watching very closely, Bloomberg's chief European correspondent, Oliver Crook. Thank you so much for that. All right, well, coming up, we're going to tell you what to expect from the budget. It is finally here. The day is finally here. That's tomorrow, obviously, with Barclays' Jack Meaning. Stay with us for that conversation. It's coming up next. This is Bloomberg. Good morning. This is The Pulse. I'm Joanna Versace in Dubai. Tech drives gains for global stocks as confidence grows over a potential rate cut by the Fed next month. But the rally fades in Europe. The gold standard under threat. Nvidia shares slip on a report Meta is in talks to spend billions on AI chips from Google. These are the market moves. You can see Nvidia down 1.5%, Alphabet up 2.6%. And tensions over Taiwan. President Trump holds back-to-back calls with the leaders of China and Japan as the diplomatic fallout continues between Beijing and Tokyo. And in corporate news today, EasyJet says it's receiving aircraft from Airbus at a growing rate, helping the UK budget carrier improve capacity as demand for low-cost travel remains high. The carrier's CEO also told Bloomberg he hoped the UK government would freeze or cut air passenger duty in its budget this week.
I hope there's some consistency in the budget. The government have been very pro-aviation and pro-growth. They really recognise the valuable role that aviation plays, especially to an island economy, in enabling growth. So I hope that there is some sort of freeze or even reduction on air passenger duty, because last time we saw a reduction in 2023 on domestic APD, EasyJet added capacity, other carriers added capacity, that increased the connectivity, increased the consumer choice and brought down fares. And I think that, that kind of action would be very encouraging, but we'll have to wait and see.
Well, for more, I'm joined by Bloomberg's aerospace reporter, Kate Duffy. Kate, it's interesting to see the price action in EasyJet stock today, because even though they beat for the full year, I guess some concerns about the outlook coming through?
Yeah, absolutely. It was a real mixed bag this morning from EasyJet. So what we really saw was this strong demand for package holidays. So EasyJet's holiday business, the profit target there has been upgraded for fiscal 2030, and also seeing a growing confidence for Airbus deliveries as well. So that they were all in line with expectations. They received 9 aircraft in 2025. Going forward, they are expecting to receive 17 aircraft as well. But what really struck us was the consumer demand as well on top of that, and that flows through into the positive momentum that they're seeing for their holidays business.
Yeah, and let me take you in a slightly different direction. Some news coming through this morning from Boeing saying that they have gained ground in its war against defects for its 737 MAX. What more do we know? Obviously, this is a big issue that's been swirling around the production of these 737 MAXs.
Yeah, absolutely. So our colleague Julie Johnson got access to one of the main factories at Boeing and spoke to the key players over there. Essentially, what we're seeing is very subtle changes, but important changes that are contributing towards the improvement in the quality of Boeing's aircraft. So what we're seeing is a decline in lost tools, also less defects in the airframe, and more inspectors looking at the fuselages that come into the factories. And this is all in the wake of the Alaska Airlines panel blowout that we saw nearly a year ago now. And obviously, they're looking to increase the FAA production rate on some of their aircraft as well. They've achieved that with the 737, also the 787, but they're not quite out the dark yet. They're still trying to get the certification for the 777X, and that's something that customers have really long been waiting for. But in terms of the reaction to the quality of the products that they're seeing, customers are really happy. Ryanair's Chief Executive Officer Michael O'Leary was a fierce critic of Boeing earlier this year, saying that that the deliveries were slow, they were stunting growth. But in more recent times, he's been really positive about Boeing's production, the communication style that they have. So yes, our colleague Julie Johnson, she was over there and really saw the improvement that Boeing is making in its factories.
Interesting. Kate Duffy, Bloomberg's aerospace reporter, thank you so much for bringing those lines from Boeing and EasyJet as well. Now, investors will be keeping a close eye on the gilt market tomorrow as Rachel Reeves makes her much-awaited UK budget statement. Bloomberg understands the Chancellor is to slash the amount Britons can save in their tax-free cash ISA savings accounts each year from £20,000 to £12,000. The move is a bid to get households investing more in UK stocks. For more, Anna Andrade from Bloomberg Economics joins me now. It feels like every day we're getting a drip feed of measures that may or may be coming in the budget. Let's just talk about the ISA here. How big of a deal is it that the level is being lowered to £12,000? I guess the goal is to try to incentivize UK savers to invest more in the stock market, but big question mark as to whether they may succeed.
Yeah, I think that's exactly right. This is part of a push from Rachel Reeves to sort of raise revenue while at the same time incentivizing growth. I'm a bit skeptical she'll be successful at either of these, essentially because it incentivizes households to move their savings away from cash, potentially into stocks, but not necessarily British stocks. And the second thing, from a public finance perspective, it also represents Reeves going after sort of a narrower tax base than, if you look at income tax, VAT, NICs, and corporation tax, these are bigger tax streams. So essentially, Reeves targeting savings and Reeves targeting pensions, which you've also seen in the news, represents she trying to get some money out of these narrower tax spaces. The problem is that they won't yield as much, and there's another big question mark about how certain these sort of revenues will be, because these are mobile tax spaces. People will adjust their behavior in response to these taxes, so there's a risk that they don't yield as much as, you know, the OBR forecasts or Reeves is expecting. And I think that's something that's worrying investors, sort of the composition of the savings, and that's something they will be looked at very closely tomorrow.
Yeah, most definitely. Bond vigilantes keeping a close eye on everything that's announced, and also whether she actually sticks to some of her own fiscal rules. What are some of the other measures or policies that we're expecting out of the budget tomorrow?
I mean, I think one thing that bond vigilantes will be looking at in particular would be sort of anything that can sort of impact inflation. And there's two things, there's two ways that the budget can impact inflation tomorrow. I mean, if Reeves delivers a big fiscal consolidation, that by default will sort of, you know, be disinflationary. It will weigh on the economy. But I guess what investors will want to see is that this consolidation is sort of front-loaded, so it happens sort of in the next few years. If Reeves sort of backloads the fiscal consolidation, investors might get concerned that she actually won't follow through with these measures in 2029, which is like an election year. That's one thing. The second thing that they will be looking at is measures that directly impact inflation. So here we're talking about, you know, freezes to sort of a reduction in the VAT of energy bills and freezes to rail fares. So all of these will sort of mechanically bring down inflation by as much as 0.4 percentage points, according to our estimates. And that's something that, you know, would be really welcomed by investors, as it would sort of clear the path for the Bank of England to sort of cut rates this year.
Ana Andrade from Bloomberg Economics, thank you for setting up our next conversation. Well, staying with the UK, my next guest says tomorrow's budget has been weighing on spending and activity in the economy. Joining me now is Jack Meaning, Chief UK Economist at Barclays. I'm going to start off by simply asking you, Jack, what your expectations are for the amount of fiscal consolidation we're going to get from tomorrow's budget.
Yeah, thanks, Jemana. I mean, I think, look, it's clear there's a lot of uncertainty around this, probably more than we've had for most fiscal events in recent years. But I think, you know, where we think there's broad consensus is the Chancellor's going to need to find something in terms of 25, maybe 35 billion pounds of net consolidation if she wants to increase her headroom from where she was last time to at least 15 billion, which is what we think the market's looking for.
Yeah, so anything short of 15 billion pounds on the headroom, you think will spook gilt investors out? Is that your interpretation, if 15 is sort of the line in the sand?
Absolutely. So if you look back at previous budgets, normally chancellors have been able to have somewhere between 0.5% and 1% of GDP, and we haven't had this repeated conversation that markets have been obsessing about for weeks now of whether the chancellor's going to breach her headroom. We did some work at Barclays with the Institute for Fiscal Studies and found that, you know, if she had 10 billion of headroom, that would give her maybe a 1 in 3 chance that at the next fiscal event she'll have to come back and ask for more tax increases, which obviously politically that's bad from a market sentiment point of view. That's not a great look. So we think 15 billion is probably the minimum the market is looking for. Anything closer to 20, anything more like 25, that's harder to get given the fiscal constraints the Chancellor has put on herself. Yeah. But actually that would be a more positive reaction from the market.
Yeah, my colleague Ana Andrade raised another good point as to whether the fiscal consolidation is front-loaded or back-loaded. How closely are you going to be watching that for? And again, you know, how closely will gilt participants be watching out for the timing of this fiscal consolidation?
Yeah, I mean, I think there are a few things within that, Jemana. The first is that actually we know that some of this will be backloaded, or we have a good idea that some of it will be backloaded in the fact that we think that the freezing of income tax thresholds for another 2 years from 2028 onwards will raise maybe 8 to 10 billion pounds of the gap. So obviously that doesn't kick in until the latter part of the Parliament. And so to some extent there will be something backloaded in there. But actually for market credibility, the market is kind of a, you know, we'll see what you do rather than what you say. And I think that means that actually it's important that, you know, the rest of the consolidation is front-loaded. front-loaded. Add into that, there's an important political economy consideration here, which is if their front-loading comes in at this budget and is in the next year or two, the peak pain for the UK economy will be maybe on our model in early 2028. If you delay, if you muddle through this budget and you ultimately end up having to make another consolidation next year, then peak pain is really hitting the economy at the point that we go to the polls for the 2029 election. And that's a difficult sell, I think.
So they've got to be mindful of that. Yeah, they've got to be mindful of that. Okay, very good point on the impact on the economy. She's also talked about, the Chancellor's talked about wanting to bring down inflation levels. Do they have the power to do that mechanically? I mean, we know that one of the measures that's been leaked is the freezing of rail fares. Is that likely to have knock-on effects to the inflation path looking ahead to 2026?
Yeah, I mean, I think there's a whole range of measures. Anna was talking about them, some of them just before this. But, you know, I think if we look at freezing of VAT on household energy bills, rail fares, maybe freezing of fuel duty, all of those things could take out 0.4, maybe 0.5 percentage points out of inflation by the time we get to April next year, maybe even sooner for some of those measures. And, you know, ordinarily, you would think the Bank of England would look through some of those price level shocks, some of the things that temporarily bring down inflation. But actually, the hawks on the Bank of England's committee have pointed to the risks that persistent inflation at the moment could lead to higher inflation expectations, more persistent inflation in the medium term. So anything that brings down that near-term inflation profile probably reduces that risk and therefore, you know, just frees up the Bank of England that little bit more to look at rate cuts.
That's exactly why I was asking that question, because, you know, the knock-on effect from that could be that it frees up Bank of England's hands to pursue a more vigorous rate-cutting strategy. What is your outlook for the Bank of England going into next year?
So going into the budget, we think there'll be 2 more cuts before the end of Q1 next year, so most likely in December and March. And then we're broadly in the range that we think the Bank of England views as neutral. So we think at that point, all else equal, they'll take a pause. Now, there's some definite downside risk to that. If the Chancellor delivers a little bit more disinflation in the budget, then, you know, on our kind of forecast, you would be taking out, again, 0.4, maybe 0.5 out of the inflation rate, and that could free you up for more cuts than our baseline.
Yeah. Are you concerned that the net impact on growth also could, you know, again, be very growth negative for the UK and put even more pressure on the Bank of England to come up with expansionary policy?
I mean, look, I think it's pretty obvious that a consolidation at this budget will be a drag on growth. Actually, if the Chancellor manages that consolidation without creating inflation and without losing the confidence of the market, actually our modelling suggests that the drag may not be too big, maybe 0.25% of GDP, maybe as much as 0.4% of GDP on the level. And as I said, that's peaking in terms of pain in around early 2028. Now, the risk is that on our modelling, if the Chancellor finds inflationary levers, either directly through duties and changes to kind of alcohol duties and things, or through something indirectly that puts costs on businesses that they have to pass through. If there's an inflationary consolidation, that could double that impact. So you'd be looking at more like 0.5% of GDP to 0.8% of GDP, and that's a more material drag. So there's a good outcome here where the Chancellor manages the consolidation with a pretty muted effect on growth. But alternatively, if she makes a misstep, which is why the market's so focused on it, then it could be a more material growth drag.
Yeah. What would you say is going to be the ultimate determinant of whether this UK budget has been a success, at least for market participants? Should we single-handedly just be watching out for the price action and gilt yields afterwards? Or should we also be focused on some of the micro sectors, the various parts of the UK economy that also may be exposed to certain measures announced tomorrow?
I mean, I think, look, across gilt yields, FX, the whole constellation, that will give an initial market reaction to the piece and tell you whether ultimately the market finds this credible as a budget. So I think we'll be looking across that whole range of asset prices. But you have to remember as well, we're kind of going into the Thanksgiving weekend. You know, there people kind of around the world may not have as much of an eye on markets necessarily. And so I think actually what we've seen in previous budgets is there's an initial reaction to the kind of headline numbers, but it's taken a day or two really for people to digest what is a huge piece of analytics by the OBR, and ultimately then to come to more sustained conclusions. So I think, look at those initial reactions, but also take time to work through exactly what's going on in the kind of the broader macroeconomic piece.
Jack Meaning, Chief UK Economist at Barclays, thank you so much for joining the Pulse today. Well, UK Chancellor Rachel Reeves will deliver that budget at 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trades will break down the numbers with key business and political voices in a budget special on Thursday. And European car sales have climbed for a fourth straight month in October as the region's automakers continue to push out more affordable electric models. The European Automobile Manufacturers Association says new vehicle registrations rose 4.9% from a year earlier to just shy of 1.1 million units. China's BYD saw sales in the region more than triple, easily outstripping Tesla, whose sales continue to slump with registrations down 48%. And New York Mayor-elect Zoran Mamdani has selected several corporate executives to join his transition team. It comes as the Democratic Socialist seeks to ease concerns that his policies might harm the city's business community. Amongst those chosen to help in his move to City Hall are former Goldman Sachs partner Margaret Anadu, developer Jed Walentas, and Kathy Wild, head of the partnership for New York City. And in other news, a federal judge has thrown out criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruled that the prosecutor who brought the cases had been illegally appointed. President Trump abruptly installed the prosecutor in September after her predecessor resigned under pressure to bring charges against the pair. Comey and James are amongst a group of Trump's perceived political foes who have faced investigations after the president called for their prosecution. And coming up, China has instructed the country's airlines to reduce the number of flights to Japan following comments by Japan's Prime Minister on Taiwan. We'll have more details next. This is Bloomberg. Good morning. This is The Pulse. I'm Joanna Bersecci in Dubai. Bloomberg has learned the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through March 2026. Tensions between the two nations were inflamed after Japanese Prime Minister Sanai Takaichi's comments on Taiwan. For more, I'm joined by Bloomberg's chief Asia correspondent, Ross Matheson. So we've all been keeping a very close eye on how this diplomatic spat between Japan and China has been playing out. What is China's latest move signal vis-a-vis the flights, Ross?
Well, as you were saying, they've given this edict essentially to Chinese airlines to cut the number of flights now through into a proportion at least of next year. And that signals that Beijing is really digging in there. In fact, both sides seem to be digging in here. It's been affecting travel to some extent. It's been affecting trade to some extent, although they've held fire on some of the really big impactful stuff, which would be, for example, if China decided to penalize Japan in its eyes by cutting off supply of things like rare earths. For now, the economic impact has been a little bit limited, but this does suggest that they're willing to drag it out. It could become quite protracted. It could, in fact, impact that peak Lunar New Year holiday period, of course, for travel in Asia. And the question again is, what is the off-ramp in this situation? Because Beijing is insisting the Japanese Prime Minister, Sanai Takaichi, apologize and retract her statement. She's saying she won't. She needs to also sound tough and that she's standing up to China because she's pretty newly in the position as Prime Minister. And so we're at a bit of a standoff here in terms of how this can be de-escalated. And the indications are from China, at least, that it's willing already to play the long game and to see this run on for quite some time.
Yeah, and it's interesting that in the last 24 hours, President Trump has had calls with both the Japanese Prime Minister and President Xi. Really speaks to the tightrope that the U.S. are walking on when it comes to Taiwan. Do we know whether Taiwan was discussed on the call that took place between Presidents Trump and Xi?
Well, at least according to China and their readout, it was discussed. Xi Jinping is said to have told Donald Trump that what they said was the return of Taiwan, which is essentially a self-governing island to China, is for China a key part of the post-World War II global order. Interestingly, the US readout of the conversation between Xi and Trump does not mention Taiwan at all. It talks about trade, it talks about the latest with Russia's war in Ukraine, but it didn't touch on Taiwan. And for Taipei at least, they're interpreting that as a sign that Donald Trump does not want to use Taiwan as a bargaining chip with China in his broader conversations around their relationship and trade, that he doesn't want to get too pulled into this. But obviously, as you say, it's very delicate times because the US probably wants this to de-escalate. Donald Trump sees himself as a peacemaker. He would not want this to be escalating, but equally he can't be seen to be siding too much to Japan, for example, even though Japan is a long-running ally of the US. And so you've got all these delicate issues at play between Taiwan, Japan, China, and the US on this, but indications at least, China says that the US instigated this call with Xi Jinping, which does suggest that Donald Trump is keeping an eye on what's happening at the least and has a vested interest in it not escalating.
Yeah, absolutely. Ross Matheson, thank you so much for bringing us the latest there. I'm going to pivot to markets now. Tech stocks were helping global equities advance for a third day, but the rally seems to have run out of steam in Europe. Bloomberg's Markets Today co-editor Marwana Kanayam joins us now. Marwana, talk us through the price action this morning. A lot of volatility going on with some of these key tech stocks today.
Yeah, absolutely. What we have seen is some of those gains that we saw earlier falling back, and actually we are now seeing stocks falling in Europe, and that's mainly because US futures are also turning lower after Nvidia shares are slipping, and that's been not surprising because it's been driving so much of the recent equity rally, and it really shows the vulnerability there and how dependent, in fact, world equities right now are on Nvidia and the AI industry that surrounds it.
Yeah, well, let's speak a bit more about Nvidia. You mentioned that the shares are slipping. Last time I checked, they were down about 2% in pre-market. But this on a report that Meta is in talks to spend billions on AI chips, but from Google. So what challenges does this pose for the industry's poster child for AI dominance?
Yeah, so it's quite significant because we haven't really seen that level of competition before. And a lot of the success is driven by pricing power. But I am kind of interested in what it means longer term, because having some increased competition does suggest that perhaps there's actually more gains to be had elsewhere in the sector. We've seen everything very much driven by Nvidia so far, and actually that does pose some risk as well, because as we've just seen, the vulnerability the moment that the sentiment turns sour. So actually, if there's some diversification, it could also make it a bit more secure as a sort of longer term underpinning of the equity market.
Bloomberg's Markets Today co-editor Marwana Kanayam. And speaking of markets, let's take a look at how some of the key European indices are faring. We are about an hour, well, almost 2 hours now into the trading session. You can see that not a lot of movement for the Stoxx 600, trading flattish. Essentially, the DAX down about 15 basis points. The FTSE, all eyes on the UK index as we head to that important UK budget tomorrow, trading sideways today around 9,500. As for US futures, this is how markets are pointed to open up slightly weaker, just as Marwana was saying, and this on back of some of the weakness that we're seeing in Nvidia. So keep an eye on that and how it all plays out. On the flip side, though, investors continue to bet bigger on the possibility of a rate cut come December. So that is your picture as we head into the U.S. session. Up next, Bloomberg Brief. You've been watching The Pulse. This is Bloomberg.